Do I have to pay taxes on a living trust? Yes, you do, but not while you're alive. So let's talk through the details. When do you in a living trust have to pay tax? And as the grantor, I can just tell you, the person who creates it, it just flows through to your personal. If it's irrevocable, it has a different form. So we're going to talk through that detail. Then number two, I want to talk through how a trust can protect your assets and reduce your tax benefits, like hugely. And then we're going to talk through what's the difference between irrevocable and the tax implications. We're going to talk through irrevocable and the tax implications, as well as the protections. So let's get going talking about these trusts. And yes, you do have to file. So let's get to some of the definitions that are absolutely imperative, I think, for you to understand. First of all, revocable and irrevocable. Irrevocable, you are the beneficiary. You actually can sign, you can be very active in that trust. Irrevocable means it's completely away from you. You have to have a trustee in between you and the transactions. So it's on behalf of whoever the beneficiaries are. A lot of times they might be your children, charity, something like that. But you can't just make decisions and sign checkbook authority of irrevocable trusts. What is a living trust and why it matters? It's a legal entity that holds your assets while you're alive, distributes to them according to your wishes when you pass. It does indeed need to file a tax return. So let's talk about the revocable and irrevocable in two different sets of terms. I'm actually going to reading some legal definitions. So the revocable living trust, with no separate tax return required because it's part of you, right? It's a living trust with your lifetime, of which you then can give as a beneficiary to whoever you so choose. It means that you, the grantor, the creator of the trust, has full control over all assets. For tax purposes, the IRS treats this as the trust doesn't exist separately from you, so it just files with you. The income from the trust is reported on your personal tax return, your 1040. No separate tax return is required as long as the grantor, the creator of the trust, is alive. When you pass, the trust may become irrevocable or have other tax obligations. Now, let's go into the details of an irrevocable living trust. A separate tax return is required, and again, a trustee stands. An irrevocable trust is treated as a separate legal entity for tax purposes. It must file its own taxes, a 1041, and must be subject to trust tax rates. So not your personal rates, your trust tax rates, depending on the amount of assets inside of it. The trust must obtain its own EIN, employer identification number, from the IRS. Trust income is taxed separately unless it's distributed to the beneficiaries. If the income is distributed, the beneficiaries have to report it on their personal tax returns, or if it's allocated to another trust, it has to go through that process depending on where the money lands. Again, you always got to follow the money trail and where the money's wired. An irrevocable trust can provide tax benefits and asset protection, but it limits your control over the assets. So you have to have a trustee as part of the facilitator of the movement of assets. So it's up to you. I have both. I have multiple. I also have ILITs, which are designated toward just life insurance trusts for my children and for me. So how a living trust protects you is it actually makes sure that you don't land in probate. So upon anyone's passing anywhere in the world, you end up going to probate with the country or the state, province that you live in. So if you're assigned a probate attorney, then they're going to take a fee. A lot of times that's 20, 30, 40, sometimes 50%. The average is 40 to 50% of your estate will be actually taken away in fees, not only to the probate attorney, but to the state and just the taxes alone because you weren't set up properly. The other thing that a trust does is it provides privacy. So I don't ever put the trust in my name or our family's name. It's just some random name, and it's not recorded anywhere. So it's just a private document between you and your lawyer, your facilitators, and upon your passing, then they can read through the trust, the will. And here's the difference between it. The trust keeps you out of probate. The will is the stuff, right? Like who gets the jewelry, who gets the cars, who gets the art, who gets the furniture, who gets the stuff. You could actually have that all designated before you pass, which is highly, highly, highly encouraged, because if you don't, you're going to end up in a war. I don't know how many families have what I call the surprise basket. They have 5, 6 kids, 3 kids, 4 kids, not educated, and upon their passing, no one knows who's getting what. No one knows where the bank accounts are. No one knows where the files are. See, in this book, and if you want to go grab this entire Gen W worksheet and workbook, it comes with a 3-day course and then 2 years of consistent updates. And it walks you through from the first page It says, I'm dead, now what? Contact these people. And it just starts a whole journal of what do you need to do upon someone's passing. So you can either have it all laid out, very scripted, almost like a blueprint upon your passing, right? What bank account information, what are your assets, what are your crypto wallets, what are your current liabilities, where do you find all these documents? Like all of this is completely laid out. Social media, what do you do with your websites? All of this stuff has to be considered upon someone's passing. And obviously, the larger the life you've built for yourself, the more work it is for the heirs to actually help to take care of it. So I highly encourage you to help manage all of this and have it organized. So upon your passing, it's fairly easy. Things that you want to keep alive and moving ahead and continue bank accounts, continue cash flow, they get to stay in order and you aren't disrupted. Many times the family is so disrupted upon a passing because they're not that organized. For many estates, having an irrevocable trust provides you the highest asset protection. In fact, there are Nevada asset protection trusts that after your assets have been held in there for 2 years, they're pretty much, that's what we call, bulletproof, where you really bulletproof. They actually make them non-litigatable. They're not even part of it because they're not part of you. They're irrevocable and some other trustee is holding them. So it's high privacy, high asset protection, and liability protection against creditors. So before I continue on and wrap up this trust conversation, which I love and I think is vital that you seriously consider a legacy, and those of you that are inheriting one, get your families involved. Those of you who are giving a bunch of money to a bunch of uneducated kids, get those kids involved. Why would you do all of this just so you could have a great life and then let it all fall down and break up? I literally have had families up to 34 years living through probate hell. I mean, it is absolute the worst because no one can move the assets. The cash flow is not moving. Even if the asset appreciated, no one can really sell it. You can't do much because it's frozen in probate court. So don't be those people. Get clear on what you want. So I need you to subscribe to my channel. I need you here 5 days a week. I have huge playlists where you can go and look for search terms. I have a lot on wills, trusts. I have a lot on corporate structure, a lot on credits and debits. So make this your family financial literacy channel on a regular basis and share it with all your family. So you're all like circling around the same narrative in your family legacy conversation. Click that notification button because when it comes into your phone, I want it to ring and say, hello, listen to me again today, just like that. And start with a journal as well. There's a journal on our show notes below. And grab the journal, take notes on what did you learn, what are you going to do, and over 365 days, you're going to have quite the action plan on what you need. When you need a mentor coach, you call our office. It's in the show notes below. I'm also giving you 3 chapters of my Millionaire Maker book. So fill out a gap analysis where you are, what you want, and how our team then can help solve any of those issues for you. At any time, go to askloral.com, ask a question, make a request. It's ASKLORAL, and we're there 24/7. The last point I want to make is, when does the living trust have to file a tax return? While the grantor is alive and the trust is revocable, which means it going directly to you, no separate return is required. So it just files with you. Now, if you've actually done some gifting, you need to put that as part of your strategy. Sometimes you do file a gifting return. Sometimes you just track it and then it's deducted off at the end on your death benefit. If the trust becomes irrevocable because the grantor has passed away, then a tax return, a 1041, has to be filed. So again, a lot of this is, who do you use for your tax strategy? Who do you use for your trust? Our goal is to integrate. These team members have to work together. There should be 5 to 6 people on the team of your legacy, not one, not just an estate lawyer. So again, if you have any questions, want our help, want our facilitation, our guidance, go to askloral.com, ask a question, make a request, say, hey, I want to really talk this through. Tomorrow, in fact, I'm actually having a meeting with the client who is putting together a prenuptial, which then will roll right into the trust. So the prenuptial is going to be a piece that will roll into a revocable and irrevocable trust. So we know to help guide, navigate, and get it done right. So stay in touch with us, and we'd love to have you on our team. Talk to you tomorrow.